What goes up must come down, as the old saying goes, and that is exactly what happened on Wall Street today. It was a very broad-based sell-off without any real triggering event, but with no major economic reports, attention turned once again, as it so often has in recent weeks, to the Federal Reserve and when the central bank may start to scale back its bond buying program. Now, one clue came from the Boston Fed President Eric Rosengren, who said today a modest pullback in the Fed's stimulus program could make sense in a few months. In the end, the Dow closed lower by 107 points, worst day in about a month. It ended at 15,302 and change. The S&P fell by more than 11 points to 1648, and the Nasdaq was off 21 to 3467. So as investors hang on every word coming out of the Fed, are big gains one day and big losses the next something we should all get used to this summer? Kelly Evans takes a look now.
Well, forget the beach. This summer, markets are already making plenty of waves of their own. Take a look at what's happened in just the last couple of weeks. Japan's Nikkei index plunged nearly 1,000 points last Thursday. Its government bond yields have roughly doubled. And here at home, the yield on U.S. government debt has also jumped, pushing mortgage rates higher. Meanwhile, the Dow Jones Industrial Average has gone from having one of its worst weeks this year to jumping more than 200 points early Tuesday to close at a fresh record high, only to reverse course today, giving up as much as 175 points. Confused? You're not the only one. These sharp and erratic moves have left plenty on Wall Street scratching their heads. The question is whether this activity is a glimpse of a more volatile summer ahead, and it stems from a larger debate over how much the economy is improving and whether the market can hold on to the 15% gains this year if the Federal Reserve lessens its support in response.
Question is how sustainable it is. Is it if they walk away? I think there's only one way to find out, and that is if they do walk away. I think politically they won't. I agree with you. I think politically they won't. I think that's the problem. If they walk away, does the market collapse, and who wants to make that bet?
In past years, markets have sold off each time the threat of Fed diminishing support arose, with growth-sensitive sectors like financials and industrials hardest hit. This time around, the worst performing sectors are those, like utilities, most sensitive to higher interest rates. In other words, investors seem to be digesting the idea of the Fed actually tapering its support. Given that, it's a bit surprising and even encouraging the market has held up this well. That could change, however, if job growth starts to flag again, or overseas markets like China or Japan weaken considerably. None of these are remote possibilities. Better hold on to your hats. For Nightly Business Report, I'm Kelly Evans.